Hi, everyone. In this exercise, I want to go over exercise 8.6. In chapter 6, what it gets into is what we call reserve accounts, sometimes called allowance accounts. But when a company sells on account, specifically accounts receivables, there has to be an anticipation that not everyone is going to pay you or might pay you late. So what we do is we set up this account called allowance for doubtful accounts that you see in this problem. So in 8.6, this company has accounts receivables 95,400. That's what's owed to them as of March 31st, 2023. They have credit terms of 2/10 and 30. The 2 means it's a 2% discount if you pay within 10 days of the invoice. So if you purchased it, get the invoice, and as long as you pay that invoice in 10 days of receipt, you get 2% off the bill. The N stands for net 30. That means if you don't take care of the discount, you have to pay us in 30 days. Right, so that's what that is. Not really relevant for this problem, but I wanted to explain what that means. It says as of March 31st, 2022, there is a credit balance in the allowance for doubtful accounts prior to the adjustment. So again, this allowance for doubtful accounts is a reserve account. It's, so to speak, it's not really money, but it's kind of like money that you put aside anticipating people aren't going to pay you. And then it goes on to say that the company uses a percentage of receivables basis for estimating the uncollectible accounts. So every year you do this, the year before you did it, and you put $2,100 too much into the account. The credit balance tells you that it has a credit balance of 2,100. A credit balance in the allowance for doubtful accounts is what we call its normal balance. So that's what it should have. The reason why it has 2,100 on in that side is they put too much in. And why they would have put too much in is because this whole process is based off of estimating. In other words, we don't know who's not going to pay us. So we just do this every year to anticipate it. So now what we're going to do is we're going to look at this data given. What they've done is this is called an aging of accounts receivables, where they took the 95,400 and spread it out. The current of 65,000, that is money that is owed to us that is still what we call current. They did side by side 2 years. Again, we don't really need this information over here for 2021 because we're not doing 2021, we're doing 2022. So again, extra information to throw you off. But again, what the 65,000 is customers that came to us in March that we sent out bills to, but why it's called current is because it's not due yet, or it's definitely not late. Whereas the 1 to 30 days, the 31, the 90 days, and the over 90 days, these are all late. What these percentages are over here is set up by management. It'll be given in the problem, but management believes that of the current people that just came in that are not even late yet, that's not due, we're not going to collect 2% of that. The people that are already 1 to 30 days late, we don't think we're going to collect 5% of that. And the people that are 31 to 90 days late, we don't think we're going to collect 30% of that. And then if they are over 90 days, which is over 3 months late, we only think we're going to collect half of that. Again, these are estimates. How you would get that is based off of past performance and what you collected in the past, right? In part A, they want us to determine the estimated uncollectible amount. And then they want us to do the journal entry and then kind of discuss, things that are going on. All right. So I will put up the solution and kind of go through this. I just need to zoom out so you can see all this. So what you see in A is really just a copy job of the numbers given. Again, they didn't give us 2021, We're only using 2022 because that's the year we're in. These are the percentages. How they got these numbers over here is they just simply took these numbers, multiplied it by these percentages to get this. Then they totaled it up. What 8,675 represents is how much we think we need in that allowance count. So people in the next year, as they start to pay us or don't start to pay us, we could take it out. So it's for setting up a reserve account. We want the balance to be 8,675. We know it already has 2,100 in it, so that's going to affect the next journal entry. But again, the calculation here is kind of simple. It's just take the amounts times it by the percentage. In B, when we record the journal entry, because the allowance account already had a credit balance of 2,100, they subtracted it from the number we calculated in A. Why we're only putting that difference is because the account already has 2,100 in it as a credit balance. So therefore, we only need to credit it for the difference of 6,575. And the debit goes to balance it. But debit goes to bad debt expense. This is increased in the expense, and this is increased in the allowance account because it already has 2,100 in it. And now we put additional 6,575. The new balance will become 8,675. So that's a little tricky. Had it said it had a debit balance, then we would not have subtracted, we would have added. So be careful of that. If it said the allowance for doubtful accounts had a debit balance, we would have added. If it had a debit balance, that means they didn't put enough in the year before, so we have to overcompensate. And the last part is just, again, explaining the whole concept of receivables increasing and the different concerns about the percentages. You could read on your own, but the whole point here is as receivables increase and you sell to people on account, one of the costs of selling on account, which means pay me later, is there's going to be some people that do not pay you because they might be falling on hard times. The economy may slip and so forth. So you got to take that in consideration. The way you do that every year, you increase an account called bad debt expense, and then you increase an allowance for doubtful accounts, which is a reserve account. All right, I hope this helps, and I'll talk to you soon.